to PWM's 9th Annual Sub-Advisory Roundtable. I'm Elisa Trovato, Deputy Editor of PWM Magazine. It's my pleasure to chair this roundtable discussion where we will examine the changing dynamics of the European distribution landscape. We will look at the rationale for sub-advisory, in particular the impact of regulation. Joining me today, I have 8 excellent panelists representing institutions from Italy, the Netherlands, Switzerland and the UK. So I would like to invite you all to introduce yourself and describe your role in the company. And also, can you state the assets, the size of assets managed by your firm and the size of assets managed on a by third-party managers on a segregated basis, roughly. So if we can start with Lee.
Lee Freemanshaw, Portfolio Manager, Old Mutual Global Investors. We manage in total around $20 billion. Roughly half of that is through sub-advised mandates.
Katia Coudray, Head of Fund Research and Product Development at Bank Seats. Bank Seats is managing a bit more than 32 billion US dollar, and we have 6 billion in funds, according which 1.5 billion in sub-advisory.
I'm Peter Preisler. I head T. Rowe Price International on the distribution side. T. Rowe is an American firm with a global presence, with a little over 500 billion in total assets. We don't disclose the specific number of sub-advisory, but it is well into the double-digit billions of dollars.
My name is Dirk-Jan. I head up the AA Advisors, ABN AMRO Advisors unit in the Netherlands. ABN AMRO Advisors is part of the private bank of the ABN AMRO group, and we are responsible for manager selection and multi-management. The private bank has about 40 billion euros invested in third-party funds, and of that, about roughly 4 billion is in sub-advisory mandates.
Nathan Gelber, Chief Investment Officer of Stamford Associates. Total assets under management are 45 billion pounds, of which roughly 40 billion are in sub-advisory arrangements.
I'm Gavin Ralston, Head of Product at Schroeder Investment Management. We manage about $390 billion in total, of which less than 5% is in sub-advisory mandates.
My name is Paolo Biamino. I'm the Head of the Fund Selection Unit at Euromobiliare Asset Management in Milan. We manage about 13 billion euros with a strong focus on multi-manager, and sub-advised mutual funds represent close to 3.5 billion euros to us.
So I'm Arguello, Head of Multi Management at Barclays. Barclays manages a little bit more than 200 billion pounds for private clients, of which around 20 billion are in externally managed and around 10 billion in segregated mandates.
Gavin, do you feel that regulatory changes will be a major factor in driving the growth of sub-advisory, in particular in the UK with the retail distribution review imposing a ban on inducements, and with other countries in Northern Europe following suit, and with MiFID regulation in Europe as well moving into the same direction?
Well, I think there's no doubt that from what we've seen already in the UK and are beginning to see in the context of the Netherlands, that the regulatory changes, in particular the ban on retrocessions, is raising the proportion of assets which are managed on a sub-advisory basis relative to traditional branded funds. And I think the driving force behind that is that a lot of distributors are looking for ways to preserve their margin, the margin that they've lost by no longer having access to rebates. There are different ways of doing that. Obviously, charging an advisory fee is the most transparent way, but another way is taking part of the asset management fee, the AMC, that would traditionally have gone entirely to the asset manager. So I think there's a very strong commercial logic behind a growth in interest in sub-advisory.
Peter, if I can ask you, for the last 9 years we've been told that sub-advisory business is about to take off. Yet we see that there are just a few institutions in Europe choosing this route to broaden the range of strategies. Is there any evidence that this boom is finally about to happen? And
no, I don't see the evidence yet, but I do agree 100% with Gavin that people are starting to think about it. In addition to the asset management fee, I think it's a well-known fact that a number of funds overcharge on O&A. So O&A is a revenue stream for asset management. If you insource those funds, that revenue, if you can maintain it, will go to the distributor instead. And a number of we've looked at this. A number of firms charge easily 20 basis points on that account. It's surprising that it hasn't caught any attention by the regulators yet or by the market, but it's a huge revenue stream that is out there for grab, and I think that in itself can be a driver.
The advisory route clearly is an alternative to the retrocession, which seems to be on its way out. The level of fees, though, is an obstacle to investors at the end of the day. And what we see happening is that advice has to be genuine advice to justify some of the more elevated levels of fees that we see in the marketplace. But there doesn't seem to be much resistance we see at the retail end to this high level of fees if the investors have a genuine sense that they're getting decent advice in conjunction with favorable investment returns.
Do you see that clients are willing to pay for advice?
Well, in our country, the advisory business has developed in the last few years. Most of the companies provide that, but it has proven very difficult to charge clients. It's much easier to charge slightly higher management fees over a direct distribution of mutual funds. So since in Italy regulatory issues are not there yet, I do believe that the classical model of direct distribution of mutual funds in open architecture will still be leading for the foreseeable future, while sub-advisory, for instance, will remain a kind of niche business.
Okay. Jaime, with Barclays, with $10 billion of sub-advised funds, do you see that perhaps all this talk about regulation is being overdone, or do you think regulation is really having a significant impact on your decision to sub-advise?
Well, to some extent it has, but we'd already had, even before RDR, a model whereby we had a sub-advised manager a number of funds. So these were relatively familiar to our clients. Obviously now we're at the first stages of the new RDR implementation and seeing eventually shifts from retail third-party funds into manager funds. But certainly from our side, we were, because we don't have a large asset manager internally, we adopted this model of sub-advised manager for a long time. So our clients are anyway used to that.
Right, right. Dirk-Jan, you come from the Netherlands. Would you say that regulations are actually forcing banks to reinvent the way they present investment solutions to clients?
Well, of course, the jury is still out. The regulation is to be implemented on the 1st of January next year in the Netherlands. A lot of banks, of course, are looking into how to change their current models. I would say, if anything, what we're seeing now when we're introducing the paid advisory concepts is that clients will become much more critical on as has been stated before, on the advice that you're giving and your own product offering. What they would like to see is some sort of a differentiation also against other competitors. So for us in itself, that is a reason also to go down the sub-advisory route, because we feel that we can offer the client a bit more than through third-party funds.
In what way you offer more?
Well, in many ways, it opens up a much larger universe of managers to us. One of the things that and that's why we have gone the sub-advisory route, regardless of the RDR in the Netherlands. One of the challenges that we're seeing, being a big bank like ABN AMRO, is that the volumes of assets that go into third-party funds are largely on the increase. And that makes the universe of funds that is available to us smaller and smaller. We're running into concentration risks with a lot of our funds. That is forcing us to look at the very big funds, which of course are, as we all know, not necessarily the funds that are the best performers. So going through the sub-advisory route, it also offers a solution to that. And we believe specifically also transparency and much more insightful reporting towards our clients will give us that edge in introducing new concepts to clients. I'm not sure, I do not believe this will be a source of directly a source of margin, of extra margin for us. I think the regulator, specifically in the Netherlands, will be very critical on the introduction of new products and new concepts like sub-advisory. One thing that I've stated very clear, and I think that's very much in parallel with RDR, is that they want the client to be charged up front, a very transparent charge for be it advisory or discretionary portfolio management. I think they'll be very wary of introducing margins at the product level if there is no clear added value that you're placing into it.
So it seems to me regulation is an important driver, but it's not the main driver for sub-advising assets. But perhaps, Lee, within your group, Old Mutual Wealth launched a number of sub-advised funds targeting the restricted advice market of IFAs. I mean, do you think that do you see the fund platforms are contributing to the growth of sub-advisory?
Yeah, so we do some of the sub-advisory for them, but they've partnered with other companies, asset managers as well, to deliver funds that they think are best in class, and they're able to deliver those fund solutions at a competitive price. Obviously, competitive price combined with a best in class offering is going to be very attractive going forward in the UK, where advisors under RDR are going to have to go down the fee route. So, you know, to be able to charge a fee, obviously then products should be very competitively priced. And I think the established large fund platforms that command a lot of assets, have long historic relationships with large investment houses, should be the ones that benefit from the new world going forward. Because at the end of the day, the more assets you have, the better pricing agreements you can come to with asset management firms, which means the end product should theoretically be able to sold through the platform cheaper. So I think scale matters, and I think we're you know, Mutual are in a good position in that sense of Scandia. You know.
Can I just make one additional point? We've talked about the attraction of sub-advisory to wealth managers. What will be interesting will be to see how the providers of branded funds respond to that, because there's no doubt that we're already beginning to see pricing affected by regulation in the UK. We're beginning to see more differentiation of pricing between higher alpha and lower alpha funds. And the asset managers who are manufacturing branded funds will undoubtedly want to make sure that the branded funds remain competitive with the sub-advisory alternative.
I think the bigger sub-advisory opportunity actually lies on the continent, where the asset manager have proprietary distribution. Because that's where there's a real gain, where you have the whole chain in-house. The sub-advice agreement will be on institutional terms, which means that they will benefit from the scale, and they can do different things. They can take a higher margin, they can keep the O&A markup if they run as such, and they can differentiate their pricing amongst their clients, because they are then deciding what fund share class is going out there.
If I can just talk a bit more on client needs. I mean, do you think that this trend for private banks and wealth managers in Europe, if they really establish strategic partnerships with a smaller number of selected asset managers, is this bad news for private clients? Does this mean closing the architecture?
No, I don't think it means closing the architecture. It means focusing your product offering. I think today already clients are perceiving, you know, not seeing the trees through the woods anymore in some cases. I think clearly it depends a lot on your branding strategy with sub-advisory, but it could be perceived as a step back in the open architecture, in the sense that suddenly you're offering your own vehicles again. Even if you communicate it's open architecture and there's an external manager behind, suddenly the client sees more of the same in his portfolio. So that's clearly a challenge that you have to go through in communicating towards clients the added benefits of sub-advisory.
But it's your own fund, Barclays funds, rather than third-party funds. So are these perceived in the same way as third-party
Yeah, to some
funds?
clients we recently need to explain several times that it's not, security selection is not at our level. Our role is really to select and combine the managers. But there is a little bit of education to be made in terms of that specific, where the different responsibility lies.
And what would you say are the preconceived ideas that you have to dispel, with sub-advisors, with advisors and clients? What are the...
I think that's the main one. Saying, people think it's a Barclays fund managed by Barclays, and certainly we have to definitely explain that different roles in manager selection blending versus security selection.